Well, hello traders and welcome. This is Ankit from Maverick Trading, and today we are diving into the world of US Treasury note futures. We'll talk about future itself and how to take advantage of these rate movements and all the speculation that goes around it, and also creating a hedging strategy for your portfolio as well. So let's dive into it. And before we dive deeper into it, let's take a look at the history first. These bond futures were created back in 1977 by Chicago Board of Exchange. Again, so these products have been around for a long period of time, and it's a wide variety of products available, starting from 2-year Treasury note going all the way up to 30-year. So what exactly are US Treasury notes? Again, these are medium-term debt securities issued by the US government maturing in 2 to 10 years. They pay semi-annual coupons and they return at face value at maturity, backed by, again, the US government, so default risk virtually zero. And you will often hear the term Treasury notes and Treasury bonds. So what's the difference? So the main difference between those two are maturity length. So Treasury notes are having maturities of 2, 3, 5, 7, or 10 years, while the Treasury bonds have longer maturities like 20 or 30 years. And when we talk about bond prices, there's an inverse relationship between the bond prices and the bond yields. So as you can see in the chart, as the bond prices go lower, the bond yields go higher, and vice versa. As the bond prices go higher, and then the yields actually go lower. Now onto the futures themselves. These are a standardized contract on the CME CBOT to buy or sell T-note at a future date. So these are perfect for betting on interest rate or hedging without looking around the actual bonds. So why do we trade them? There's insane liquidity in them. Millions of contracts are traded daily. Leverage lets you control 100,000 face value with just 5 to 10% margin. And there are options for 2, 5, 10, or 30-year bonds, with primarily the 10-year being the most popular one. But depending on where the big movement is, you can go for the shorter end of the curve versus going to the longer end of the curve. Now, I often get asked that question, why trade futures over other instruments, including options? Well, the main important one is flexibility. The ability to hedge against the market at all times is an asset. As the futures are available 23 hours a day, 5 days a week, there's a high liquidity in them, a good amount of leverage with lower capital, and you also have access to a wide variety of contracts, so it's a great way to diversify your portfolio. So the main question is, what are the market drivers that influence these future prices? And again, there are many factors, but the most important one are those economic indicators and their Fed policies that really shape these price movements. We get these inflation expectations, those Fed meetings, those CPI bombshells, those jobs data. There's so many factors that influence the bond prices, the market sentiment, and inversely, that affects those Treasury T-note prices as well. And as I mentioned about the trading hours, again, these futures are available almost 24 hours a day, 5 days a week. The only downtime is between 5 p.m. to 6 p.m. Eastern Standard Time. So as you can see, it gives us a greater flexibility and options to trade them around the clock. And again, these futures products are available to you at all of your trading platforms, depending on what you use. Personally, at Maverick Trading, we use Interactive Brokers. But again, these are the futures available pretty much at every brokerage. Now, getting started in futures trading, first thing you need to make sure is that you're educating yourself. Knowing how to trade them is the first step. Now, setting up an account is the easy part. Again, if you already don't have a brokerage account, that's where you have to set up an account. If you already have an account, you should be able to have a demo account attached to it. And this is where you can go and practice. And really, that's the best way to learn anything, is by practicing. And as you begin placing trades in your demo account, you need to understand the basic of those trading strategies. Why are you going long? Because I expect the interest rates to go fall, or am I shorting because interest rate are expecting the interest to go higher? So again, this is a great way to speculate on the interest rates as well, along with other trading strategies that you have in your portfolio. These are the future symbols that you need to make a note, add them into TradingView or your brokerage software, and starting from 2-year goes all the way up to 30-year, and you can start watching those prices. And for more information, or if you have any questions, you can always email me at ankit@mavictrading.com, or you can visit our website at mavictrading.com and look for some educational content there. Thanks for watching. See you in the next one. Happy trading.